Good afternoon, viewers. Welcome to another round of a webinar. Thank you very much for joining in. My name is Varun Ratra. I'm your host for the day, and I've got my colleague Ravish Vastava with me. How are you, Ravish?
Hi, Varun. I'm absolutely great, and thank you very much for taking time. And we are, in front of our viewers. So we are basically highlighting different topics today, right? And we had done a webinar before as well. I'm pretty sure people who have missed out the previous webinar can subscribe to our channel and look at the webinar. Now, this webinar is basically, highlighting the geopolitical tension, the interest rates, the penny stocks, and the dividend companies. And I'm pretty sure this will be good enough for viewers to pick up some picks.
Brilliant. Thank you, Ravish. So just to mention our company's name, we are Veye Pty Limited, and it is spelled as Veye Pty Limited, and our website is veye.com.au, which is veye.com.au. So before we move on to our agenda for the day, a small housekeeping thing we got to cover. Any advice we give is general in nature without keeping in account your personal financial needs. Kindly speak to your financial advisor or broker before you act on any of our reports. So we've got so in today's agenda we've got how are the markets going to react to geopolitical tension. Then we will talk about interest rate and rising inflation. Then, yes, we've got three interesting companies that are penny stocks. So we'll talk about those three companies. Then we have got people looking for dividends in the market. Hence, we are covering three dividend stocks as well. So now, okay, so to begin with the geopolitical crisis, as you know that there have been some recent developments around the world, and globally countries are fighting the twin issues of rising inflation and its offshoot, increasing interest rates to control it. So currently, ongoing Russia-Ukraine crisis and imminent geopolitical tension between US and China concerning Taiwan are not relenting and adding to wars of the stock markets worldwide. The general view is that while Russian war has already been factored in, and any resolution of the crisis will only have a positive effect. The US-China till now are more posturing than escalation. So as stock markets look forward, these appear to have already been discounted. The accumulation is already on at the moment in certain sectors like bio and tech. So let's talk about ASX, how ASX has performed in recent days. So we have seen a solid recovery in the ASX. ASX has gained momentum over the last 1.5 months as big companies like BHP, Newcrest, Whitehaven Coal, they continue to deliver good results. So lately, obviously, it's an earnings season going on, as you know, and many companies on ASX they posted their results, and some heavyweights like BHP, Newcrest, and Whitehaven, they've done pretty well. Other than more positive results from top ASX companies, the main driving force seems to be the theory that central banks such as Fed and RBA will be able to slow the pace of interest rate hikes as inflation indicators start to point downwards, even as the inflation rate remains greatly elevated. Also, rising the oil price amid a continuing energy crisis in Europe has led ASX to rise with the big mining names and particularly the energy stocks enjoying excellent trading. So, how Nasdaq has performed in last 1 month? If you see, we have seen a staggering recovery in Nasdaq. And in last 1 month, Nasdaq has recovered almost more than 10%, so which has been pretty good. And followed by ASX. Even ASX has recovered almost 7% in last 1 month's time. So now another very interesting topic to talk about, as you know that most of the investors in the market are worried about rising inflation. So we will touch that part as well. So rising inflation and interest rates are, uh, are the story everywhere, as you know. So interest rate rise, as you know that RBA raised the interest rates from 1.35 basis points to 1.85 basis points on 2nd of August 2022. The RBA board said that the rate hikes over recent months have been required to bring inflation down and to create a more sustainable demand and supply. The central bank has reaffirmed its commitment to doing what is necessary to ensure inflation returns to target while paying attention to the global outlook, which states clouded by the war in Ukraine, its effect on prices of energy. So now, moving on to the companies now, we will begin with the three penny stocks that we have shortlisted. We've done extensive research on these three companies, and we believe that these three companies are pretty good. People who are looking for penny stocks in their portfolio, they can look at these companies. But just to remind you that penny stocks are volatile, so kindly do your due diligence. And what they say that never bet your house on penny stocks. So be careful when you look at these penny stocks. They can bring big returns, but at the same time, they can tank as well. So just be careful. So now, Ravish, would you please let us know what is the first company we're going to cover in penny stocks?
Yeah, absolutely. My pick, Varun, in this current scenario would be basically picking something from construction and engineering. And this pick maybe Decimil Group. So Decimil Group is basically into construction and engineering solutions, and they have been in the market for almost like 40 years. So they are a pretty old company. Listeners can write down the three-letter code, which is important. And this is DCG. So that's Delta Charlie Golf. And Decimil is basically into construction, engineering, accommodation, right? And this company has constructed Home Ground Gladstone, which is an accommodation village that has the recreational facilities for workers who are living there. Now, the good thing about Decimil Group is they've won many contracts recently. So they have got roughly about 24 contracts as of right now, which is valued at approximately 137 million. And they've also won a contract recently for 98 million terms. So this company is looking extremely good right now. Also, they've won a contract for approximately 34 million for lithium valuation. So with Decimil, the best thing is that their projects are doing extremely well. They have restructured their debt facilities as well. We had given a buy onto Decimil at somewhere around 10 cents out of my memory. And Decimil has performed tremendously well. If we look at the charts for the last 1 month, I think Decimil may have gone up more than 100%. But still, there is a lot of juice left in the company. And with the current pricing, I think trading at a price of around 24, there is further scope for Decimil to go up and get as close as 40 cents from here on. So that it's still a long way to go. So anyone who has missed out the previous sprint on Decimil, I think they can have a very good look at Decimil if they're looking for capital gain. Now, the second sprint may not be as fast, but still there is a huge scope for DCG to do well. So that's my first pick, Varun, and I'm pretty sure the next two picks that you would basically tell our listeners would be good too.
Yes, Ravish, thank you very much for putting light on Desmil. And yes, of course, it has performed really well for us. Uh, Quite a few subscribers I know that they hold a Desmil and they're sitting on decent profits. And what we anticipate that Desmil has got more room to perform from here. Hence, we see somewhere around we see another 80 to 90% run in Desmil from here. But having said that, obviously anyone looking for a company like Desmil got to keep a medium to long term view. You got to be patient with the company. They have got around $600 million worth of order books. So yeah, so the company looks pretty good to us. Now, moving on to a second company we've got on the list, a very interesting company to talk about. We covered this company in our emerging stocks report, and a lot of people have gone through the report and they really like this company. So do we, and we think this company has got a good upside potential. So the second one we have got on the list is Letrob Magnesium Limited, and the ticker is LMG, which is L for Lima, M for Mike, G for Golf. So look at this company; they're really good. I think lately they have slipped a bit in last 2-3 days. We picked them at 7.9 cents exactly. That was about 1.5 months ago. And the stock went from that price, the stock went up to 10.5 cents. But we have seen a bit of a retracement in the stock in last few days. But we think that this company in a long run can perform really well. So why it is important? Because anyone looking at this company, you need to know the economic significance of magnesium. So magnesium is something which is gaining traction in last 1 or 2 years, and there are quite a few reasons why. First of all, because magnesium, obviously, if you talk about magnesium as a commodity, given it has the best strength to weight ratio of all common structural metals. It is increasingly used in the manufacture of car parts, aviation industry, laptop computers, mobile phones, and power tools. So magnesium produced by Letrob can replace steel and aluminum, as it is stronger and 75% lighter than steel and 33% lighter than aluminum. And another best part about magnesium is that it is 100% recyclable. And apart from this, Latrob, they are developing a process that turns brown coal waste into a valuable mineral. So very interesting company. They have already got MOU signed with the American and Japanese companies because China being the global leader of magnesium production, Americans and Japanese, they're looking for alternative. Hence, Letrob is in a sweet spot to perform well. So we think it's a very strong company to look at. Anyone looking to buy Letrob, obviously it's a decent price right now. I think they're trading around 9.2 or 9.3 as we are talking. So we think this company is a good company to be considered at this price. Okay, so now we've got third company on the list, another very interesting company. Most of the people who have been investing in the market, may be aware of this company already. But we believe that this company, if it is considered for medium to long term, can show its true colors and can perform really well. So the third company we have on the list is Cobalt Blue. The code is COB, which is Charlie Oscar Bravo. Cobalt as a resource is used by cathode makers, commodity trading houses, and mining companies to produce lithium-ion batteries. As per the Cobalt Institute report, cobalt demand is expected to keep growing to about 320,000 tons annually over the next 5 years. Cobalt Blue Holdings Limited completed mining 2,300 tons of the ore for the Broken Hill Cobalt Project, a demonstration plant program. Another highlight that we have, transitioning to operations from the remainder of the plant aims to produce mixed hydroxide, precipitate, and cobalt sulfate. Large scale industry pre-qualification, test samples expected to be shipped from August. So these are the highlights that we have for cobalt, and as you know, again, another company that we have covered, that belongs to a very critical commodity, which is again gaining traction. Mainly, the Americans, they are looking to buy cobalt, and then we have China, who's the main consumer of cobalt. So China is the country who consumes cobalt mainly. And apart from this, cobalt is, as you know, that it is primarily used in lithium-ion batteries, and also in the manufacture of magnetic alloys. So that is used in magnetic alloys as well. And another area where cobalt is used is wear resistance and high strength alloys. So this is where the cobalt is used, and as you know that the demand of lithium-ion batteries is going up because of the electric vehicle, and that is the reason why cobalt is in demand right now. So yes, so cobalt overall, cobalt as a company, COB, it has done really well. It has given tremendous returns already in last 12 months. So they're trading around 81 cents right now, which we believe is a very good price to consider this company. And this company has crossed the $1 mark already in the past. There has been a retracement in last few months, but we think cobalt as a company can perform really well. And if you look at their last 1 year return, it has been around 250%. So that's pretty phenomenal, and we think that this company from here can perform really well. So yes, so anyone, as I said before, looking for a medium to long-term investment, looking for a company under $1, can consider Cobalt Blue Holdings. Okay, so now moving on to the dividend companies. So we've got 3 companies on the list. We'll pick those companies one by one. So I'll let my colleague Ravish to start. So Ravish, which is the first company you're going to talk about?
So moving on from penny dreadful companies to dividends. So this is basically for our listeners who are more inclined towards the dividend yield, which yes, it is pretty important in a volatile market because everyone wants a regular income to come through. Now today, my pick would be basically not into the financial sector, but I'm going to pick up a company which is into consumer cyclical. So the bet would be on Shaver Shop Group Limited. So this is basically SSG, Sierra Golf. And Shaver Shop is into a variety of categories. So they are into electric shavers, they are into grooming products particularly, and they make grooming products for men and women both. So if I talk about why we have picked up Shaver Shop, firstly, it's a huge market that they are catering to. If I tell you the industry analysis of the whole grooming sector altogether, one you would be surprised to know that beauty and personal care industry in Australia is valued at $10 billion plus. So it's a huge market that they're catering to. And not only in Australia, they're also catering in New Zealand as well. Right. So they've got their market presence in both Australia and New Zealand. And also, if I talk about the segmentation of men's grooming market, the men's grooming market is estimated to be roughly about $1 billion plus. So this creates a huge chunk of potential for Shaver Shop to grow further. Now, if I just talk about the dividend yield of Shaver Shop, it is roughly to the tune of 8.5%, right? And if I talk about the industry dividend yield is roughly under 5%, plus the sector dividend yield is roughly under 4%. So if you compare even the sector and the industry, Shaver Shop has got a major advantage. And they've got exciting brands apart from Shaver Shop original brands. They also, supply Philips, Braun, and they have this Skull Shaver as well. But their most of the profit that they generate is 60% of the profit comes from their original sales, that from their original products that they come. So they have witnessed approximately 3% growth in the net margins, and Shaver Shop is into a very resilient business model. So they are very effective. Their online sales have been growing as well, and with a clean balance sheet. So if we pick up the balance sheet of the company, they've got a very clean balance sheet. There are no debt at all, and they've got a very strong cash conversion. So this creates a very good potential. Now, this is one of the latest recommendation that we have given on the website, Varun. So we have just covered this company about a few days ago. I think on the 16th of August, we had put it on the website. And we gave a buy on SSG when they were somewhere close to $1.15. Now they're just around the same price, maybe just a marginal change in the last week or so. But SSG looks extremely positive right now to me. If someone is looking for in the grooming category, this company has got a tremendous potential. Now, risk on this dividend company is pretty much low to medium. So it's not a very high risk company. So our listeners can pick up the companies if they are not committing themselves to a huge risk. So they are looking good. They're trading at a low PE of 12.5 times right now. And we have set up a target of roughly $2.64 to $3.20. It may happen, in the next 12 months or 15 months timeline. But we really think that SSG could be a very good pick right now. So this is the first one that I've got. And now moving on to the second pick. Now I'm going to pick up something from property today. And, property market has been rising up pretty significantly in Australia. Specifically, if we talk about the cities, Melbourne and Sydney, property market has been growing approximately at a rate of around 23%. So that's a huge jump what we saw couple of years back when back in 2020 when COVID started. We did witness a slip in the property sector altogether, and that pretty much obviously happened all across the world as well. So Australia was not left, but Cedarwood Property is my pick. So that is CWP. And CWP is engaged in the property investment and development. So what they do, basically, they're into urban land subdivision, and they have their portfolio of asset across Australia. So they are prevalent in Western Australia, Victoria, Queensland, South Australia as well. And the dividend yield on Cedarwood Property is roughly 6%, and it is 100% franked. So that's the good thing about CWP. They are into real estate sector. Again, if I mention, this is not a very big company. I think the market capitalization should be just close to $400 million. And they are trading at a PE of around 15 times right now. So their target, Cedarwood Property, the target could be somewhere around $6 on them. And I will just tell you the current price of Cedarwood Properties is roughly $4.50. So this is looking good as of right now, CWP. So anyone who is looking for real estate, this company has got excellent potential. Now, if I just talk about the dividend performance, the dividend that they have given and the dividend history in the last few years, they have been maintaining consistent dividend payouts. And that is what we all need. We need companies to give dividends on a regular basis. So not only luring people to get into that particular company and ultimately denying it, but Cedarwood Property has done over the years. And that is what, builds the trust of our members to buy and go for that particular company. So CWP is again a very strong company, and only because the residential property market has been surging. And if I talk about the numbers, the Australian residential property market has surged to approximately $10 trillion. So it is recording at a very fast rate as compared to 2021. And as I mentioned previously as well, the residential property prices have gone up approximately 23% throughout 2021. So this is the second pick, Varun. So one I have picked it from Consumer Cyclical, Shaver Shop, and this is the second one, which is from the residential property, that is Cedar Wood. And now I would request you to give our viewers one more hot tip in the dividend sector, and I think that would come from you. So basically, over to you just to find out which is the third one.
Brilliant. Thank you, Ravish. A very interesting company you talked about, Cedar Wood. And yes, before I move on to the third company, one interesting factor that we have about Cedar Wood is there are more migrants shifting to Australia, as you know. So which is obviously a good point to mention when it comes to considering considering company who's into property development. So yes, so I think the expected numbers are going to be 200,000 over the next 1 year. So there are going to be more first home buyers, hence that should support Cedar Woods further. And investors with the self-managed super fund can look for CWP for a long term. And yes, they've got a very decent dividend history, and we hope they continue paying dividend the way they have been. And yes, in a good company to be considered. So now, third company, a very interesting company. We believe that this company is pretty good and can perform really well. And the company's name is NRW Holdings. NRW Holdings is the provision of diversified services to the resources and infrastructure sectors in Australia. And we think this company is a very strong company to consider, and there are quite a few reasons why we like them. So first, we have NRW Group work in hand grew to a record 5 billion. The near-term tender pipeline capable of being awarded in the next 12 months has strengthened to 19.5 billion. The contracts awarded further demonstrate the strength of client relationships. They also further mark the capability added to the NRW Group following the acquisition of Golding 5 years ago. So yes, so dividend yield is very good. At the current price, as we are talking right now, they are trading at $2.28. And as per the current price, the dividend yield is 4.61%. And dividend is fully franked. So good company to consider. We think they can perform really well. And the PE ratio is pretty good, which is 12.42, which is quite satisfactory with a market cap of 8.45 billion. And if we talk about the risk factor, then the risk, what we believe is from low to medium. So good company, anyone looking for a stable company, anyone looking for regular dividends can look for NRW. And we think this company has got potential to perform well. And also one more point about NRW is that their earnings are forecasted to grow at a compounding annual growth rate of 9.6% between financial year 2022 to financial year 2026. So that's another interesting point here about NRW Holdings. And yes, we believe it's a solid company to look at, and we think this company can perform well over the next 2 to 3 years. Okay, so now we have come to an end. So I hope you enjoyed listening to the companies we have talked about. You can always email us if you have any queries. Our email address is info@veye.com.au. And you can also call us at 0290254957. Okay, and apart from this, you can also visit our website, which is veye.com.au. We have got variety of reports on our website where we cover companies from blue chips to mid cap, from mid cap to penny dreadfuls. So we cover all sort of companies across ASX. And apart from this, this webinar will also be available on YouTube. You can leave your comments if you liked the webinar. Even if you didn't like it, you can still leave reviews for us. That will give us an opportunity to improve. And apart from this, any interesting company you think that we can delve into and we can do our research, you can let us know. and we'll be more than happy to perform our extensive research on those companies and come back to you with our opinion. Okay, so we are signing off now. So thank you very much, everyone.